I will say it is interesting when I think early in my career in 2007, watching my portfolio go down 60% during the financial crisis. Well, losing 60% of very little money didn't seem that important. And all I was trying to do at the time was find more money to put in the market. Whereas, yes, today I am focusing more on the investment side. And one of the things that's changed for me over my career and that I feel like I have to there's conflict constantly, mental conflict for people to understand is the issue of individual stocks. And you address that head on in the book by suggesting that people shouldn't do it. And I totally agree, but maybe you could explain from your perspective why that is.
Yeah, so I think my argument's a little different than most arguments. I mean, if you ask most people or why you shouldn't own individual stocks, they're going to give you what I call the performance argument. And this is the most common argument you're going to hear, which is like, you look at the data and most active managers, aka stock pickers, can't beat the market over a 3 to 5 year period, especially after their fees, right? So that means you're probably not going to beat the market either. If the professionals can't do it with teams of analysts and research and all this money and resources, you're probably not going to do it either. That's a good argument. It's not a bad argument at all. However, my counter to that is like, I mean, you can look where you can find this data. It's called SPIVA, SPIVA. If you look up SPIVA, you can look this up in any equity market around the world, and you'll see somewhere between 60 and 80% are going to underperform. That's a performance argument. The argument I made in the book is more of an existential argument. It's more about your personal, like how you feel about your career, right, and your investments. Like, you can't prove, it's very difficult to prove that you're a good stock picker, right? It's not like basketball. If you and I went to the basketball court, Peter, I have no idea your basketball skill, but if we played for 20 minutes, I can probably tell if you're decent, you're okay, you're really good, whatever. And I'm not even a professional basketball coach. A real basketball coach who's an expert could tell you exactly where your skill level is. I can tell you if you're even close to like LeBron James or not at all, right? So that's the thing. You'll know instantly. You can pick any person and they go and play basketball and you can know instantly their skill level or some range of their skill level, right? But with stock picking, you can't do that. It might take years. It might take 1 year, 2 years, 5 years. I mean, let's say you pick 5 stocks and they beat the market. Are you a great stock picker or did you get lucky? You don't know. I mean, it could take, honestly, to statistically prove you're a great stock picker, it could take 10, 20 years. I mean, Corey Hofstein's run the numbers on this type of stuff. And it's like, that's the stuff that messes with me. Like, I don't think I could be a stock picker just because like, I'll never know if I'm good. And like, okay, what if I was good and now I'm not good now? Like, you don't know if your skill's gone or if you're just getting unlucky. Even the best stock pickers who are undeniably, statistically the best stock pickers are still like go through bad periods. So like, you're going to be in your head, like, am I good? Am I not right? So if you want to pick stocks and put a little bit of your money in there and have fun, go ahead. I have no problem with that. I even own a stock or two here or there, but it's like 1% of my net worth. It's just something I do for fun. It's not something I think you should do with the majority of your money. But if you're trying to do it for the bulk of your wealth, I think you're going to get in trouble. And I think, especially right now, early 2022, we saw these tech stocks are down 60, 70, 80%. And I think people have learned that lesson now, because even if they bought it early, like, wow, it went up so much, now they're down so bad, they're actually underwater from picking stocks. So I think this lesson is being learned right now in real time. And I think that's something that, I want to focus on. So
I really like that argument. And it's something that's very hard for people who have been doing well to accept. And so oftentimes, you're right, people point to the performance stuff. They show, hey, active managers lose. Hey, 40% of stocks experience a 70% permanent decline at some point in time in their lifetime. But really think, once you really grasp that everybody's really smart, and even then we can't know who's skillful and lucky, it is very difficult to understand the competition you're up against. It's not one-on-one with individual stock picking. Another common theme that I feel like I am coaching people through is when they're sitting on a large amount of cash, whether that's from a windfall or they've just been saving in cash for a long period of time because they've been nervous about investing or whatever reason. And typically when you invest as soon as possible, that gives you a higher probability for higher returns. But a lot of investors prefer to dollar cost average into the market. And I thought the supporting evidence that you laid out, and this was very graphic heavy, was really compelling. So maybe you could go through some of those arguments. I know you can't recite data off the top of your head, but some of the baseline arguments for why it's important to invest as early as possible.
Yeah, so and for the record, I want to just use specific terms here because the term dollar cost averaging is used for a lot of things. And the original, my understanding, the original time it was used, it just means buying over time. Now, what you're talking about is like if you have a bunch of money and you slowly average into the market. So I'm trying to rebrand this to call that averaging in, because dollar cost out, like when you get paid in your 401k every 2 weeks and you just buy, technically that's like small. You're just making small lump sum payments. That's technically what it is. But I call that dollar cost averaging. That's what people like to use most. The dollar cost averaging you're talking about is when you're averaging in. So let's just say average in versus buy now. That's the kind of what I used in the book, and I want to use those terms to make it simpler for people. So basically, on average, if you do buy now versus averaging in over the course of just 1 year, you're going to outperform about 70% of the time when you do buy now versus average in, and the outperformance on average is going to be about 5%, right? So those are the numbers, right? It varies per asset class. I've done it in income producing assets such as US stocks, international stocks, real estate, etc. I've also looked at like non-income producing assets like Bitcoin and gold, and the outperformance is there. And so it's like somewhere between 60 and 80% of the time of periods you're going to outperform, and you're going to outperform by something like 3 to 5%. I mean, Bitcoin's a lot more because the price has been just basically up and to the right. So let's ignore that one for now. But the point is, like, you're going to make more money generally by doing that. Now, I know that's not the only thing people care about. Why do people average in? Because they're worried about risk, and that's fair. So I think it just depends on how long you take to average in. For example, if you're like, I don't want to put it all in this month, I'm going to average in over 3 months, go ahead and do it. Honestly, that performance difference is so small, it's not going to make a difference. But if someone's like, oh, I want to average in over 5 years, I think you're really going to take a hit doing that. And I think that's something where 1 year is not too bad. And so like, I still wouldn't recommend averaging in over a year, because remember, the market can rip upward. However, 1 year is not that bad. It's 5%. So if you're willing to say, you know what, I'm willing to give up 5% for this, do it. That's the trade-off. I'm not telling you what you should or shouldn't do. I'm just saying, here's the data and you kind of think about it. I think you probably should generally go earlier, but the longer you wait, the worse it gets. So that's kind of the main takeaway. So if you want to say, okay, I'm willing to give up 5%, okay, then wait a year. If you're willing to give up 10% of your money, like an on average loss by taking 2 years, go ahead. But that's the risk you have to, that's the trade-off you have to make. So that's kind of the main point I want to get across. Is not like, oh, you have to do this, because I understand why people don't, but at least know why you're doing it and what you're willing to give up on average. Now, it could be worse, but that's kind of the point.